Hey out there, welcome to another Kevin Strong show. In this show, we're going to talk about DIM housing and stock market outlook. Those of you who have been following me on Facebook know I have been on fire with some of my stock picks. I do have a recommendation that I am going to follow for next week. I have already placed that trade, so we're going to take a look at that. And because the market is still live, we'll get some real time intel on that. The first portion of this video show, we're going to talk about housing outlook based on Fannie Mae. And then we're going to slide over and look at some stock market stuff. And that's pretty much going to wrap it up. So welcome to the show. If you're new, thanks for watching. Consider two things: subscribing and hitting the like button. Wanted to freshen it up a little bit. No jokes. I had one that I thought might have been kind of funny, but it probably would have turned a couple people off, but I decided not to do it. So let's go ahead and jump over here and look at this information here. So as I promised, the first half of this video, we're going to talk about Fannie Mae's outlook. They're really gloom about home sales. Buyer strike continues despite dropping mortgage rates and surging listings, which means the demand for houses in aggregate is gone down. There are exceptions to this, but I have to say that because people will comment and says not in my market. I know in my particular market, I live in the area called Lake Tapps, Washington, which is a pretty nice area. It's in Pierce County. It's about 40 minutes south of Seattle, Washington, for those who are not familiar with the area. And there's some really nice homes on my street. One lady is just across the street from the lake, and she's had her house up for, I don't know, maybe 3-4 months now. She's reduced the price by over $150,000, and she's not even getting a sniff. And there's another house on the same side of the street as mine, is this other lady's house I just mentioned. That house has been trying to be sold for sale by owner, FSBO. And I think that's been on the market for 5 months. The school district is called Derringer School District. So those of you who are familiar with my area and that school district know that the area is very nice. The school system is top notch. So typically speaking, a year ago, homes in my area would fly off the market easily within 45 days, despite a higher than normal price ticket. So let's go ahead and do a deep dive a little bit into this article and talk about this. It says, we've been saying for many months now, Fannie Mae Economic and Strategic Research Group is saying the same thing. The buyer strike is expected to continue despite much lower mortgage rates. Although mortgage rates have fallen considerably in weeks, we have not seen evidence of a corresponding increase in loan application activities. We're going to take a look at that as well. Nor have there been an improvement in consumer home buyer sentiment, Fannie Mae said in a report today. This is a recent article that just came out September 18th, so just a couple days ago. Goes down a little further. It says, we think it's likely that many would-be borrowers are waiting for affordability to improve even further, and that some may be anticipating additional decline in mortgage rates given expectations that the Fed will lower the federal funds target rate. So the average consumer smells blood in the water when it comes to the Fed cutting rates. Most people know that once you start cutting, they're going to continue to cut. So people are a little bit gun shy, no pun intended, to the point where they're saying, hey, why would I even jump in now? I anticipate that rates are going to come down further. Therefore, I anticipate being able to lock in at a much lower 30-year mortgage rate. So I will just continue to sit on the sideline and monitor the housing activity. So that's a little bit more of an editorial explanation of what they're talking about. So let's go ahead and look at some stuff that kind of graphs that kind of illustrate some of the points that we're discussing in this article. This first one is called the average 30-year fixed mortgage rate. We're going to go back to 2017. As you can see here, there's a big dip. And there was a really big drawdown in the 30-year fixed mortgage rate during the healthcare crisis in 2020. And then we kind of moved up in 2022. Those of you who follow me in terms of the stock market will get an appreciation for this. And this is why I will continue to tell you, not only should you learn how to trade stocks and do options, but understand how to read chart patterns, because once you start to understand chart patterns, you can apply that knowledge to any type of chart. Thus, what we have here. So as you can see here, there was kind of like a peak between 23 and 24. This is setting up as what's called a head and shoulders pattern. So for those of you who do not follow the stock market, let me explain this to you, and then I'll apply that knowledge to how you could potentially benefit from it if you're thinking about getting a 30-year fixed mortgage in the near future. So what a head and shoulder pattern is it's a head and a shoulder. So the top would be the head, as you see the crown right here, which is between 2023 and 2024. The left shoulder is right here between 2022 and 2023. The right shoulder is a little bit past 2024. So thus, here's the head right here. Here's the left shoulder and the right shoulder. This line here, along this line is a little bit above this green solid line, is called the neckline. So just imagine that being your neck, your left shoulder, your right shoulder, and the head. If this continues to go down, 30-year fixed rate mortgages, which it will, and it breaks the neckline, you can anticipate how much farther down it's going to go. So from a stock analysis standpoint, how you determine that is that you take the top of the head all the way down to the neckline. So as you can see here, we're looking at roughly a little bit below or at 8%, let's just say for easy math, and let's call this neckline 6%. So let's say that's 2%. This percentage here from 8 to 6 is the top of the head to the neckline, and that is where you start to measure how far it will go down. So once it breaks this neckline, that's called confirmation that the head and shoulders pattern has broken. And statistically speaking, maybe 75, 80% of the time, not all the time, you can figure from the neckline break point all the way down another 2 percentage points, it could come down as far as 4. Now, I don't know if it's going to come down that far, but I think there's a possibility between now and the end of 2026 or by the first quarter of 2027, you could potentially, not guarantee, potentially see 30-year mortgage rates, I'm going to say somewhere around 4.5% to 5% easily. So that's a prime example of how understanding stock patterns can apply to something like this. So for those who are sitting on the sideline, using my famous tagline, keeping your credit score up and your debt down, I would, not giving financial advice, but if I was in the market, I would continue to wait on the sideline because inventory is going to continue to go up and rates are going to continue to go down. And that's going to put you and your family in a better financial position to be able to afford a home, especially in lieu of dealing with inflation, increased property taxes, and homeowners insurance and things like that. Other costs that you have to pay for that are not necessarily associated with it directly with the mortgage, but it definitely affects your overall quality of life. So I would continue to monitor that and enter at your own risk. This next chart is sales of existing homes expressed in annual millions. As you can see right here, this goes to 2023. This is really bad. It hasn't been this bad almost since 1995. Once again, you can see here, this is kind of like a trend line. Once we break this trend line, which looks like we're about to break, I think it's going to get worse than 1995. Once again, this is probability, not guarantees. So as you can see, the sharp decline here from 2021 all the way down to 2023. When is the last time we've had such a sharp decline? You have to go back to the great financial crisis to see that much of a drop. And it took a long time before home sales get back up to that level. And as you can see, they never did. So I would think whenever this thing turns around, it's going to be years before we even get back to where we were at in 2021. Kevin, why do you say that? Look at the peak in 2005, and we've never seen it since. So even if it took this much time to start bottoming up around 2012 to get to 2022, that's 10 years to get about what? Maybe 3/4 of the way up here. So even if we try to get 3/4 of the way up here from where we've come down from, that can easily, just based on historical information, take you another 10 years. This is why you have to proceed with caution. Do your own due diligence and make sure you're buying something that makes sense. And more importantly, something that you can afford in the long run. The last chart we're going to look at before we slide over to the stock portion of the show is purchase mortgage application, people who are putting in mortgage applications to purchase a home. All of you who've been following this have seen we're pretty much at, this chart doesn't go back, we're almost at like a 30-year low. Once again, using stock analysis, lower highs, 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 lower highs. This is trending down, and it has been trending down since 2021. So what's the likelihood of purchase mortgage applications, which are currently at around 140 expressed in the millions, getting anywhere remotely where they were before the healthcare crisis? Look at that gap between where we're at here and how far it has to go up. Easily more than 10 years. This is why you have to exercise some caution, which also is ironic. And I mentioned that is that everybody knows that the Fed just cut. The Fed cut by 50 basis points on September 18th. Ironically, they cut 50 basis points on September 18th, 2007, right before the great financial crisis. So I told you I was going to show you something that clearly, those of you who follow me on Facebook, I told you I was going to show you something that says historically what happens when the first rate cut is 50 basis points instead of 25. It is a very ominous signal to the stock market. And those of you, this is not financial advice, those of you who are remotely thinking about retiring and counting on your 401k or your 457 deferred compensation plan in the next 5 to 7 years, probably need to reposition those dollars into something a little bit more safe for capital preservation purposes. So without further ado, let me go ahead and jump over and show you this chart. It's going to be kind of self-explanatory, but it's definitely worth talking about. So here's the chart. I'm going to give my mouse a chance to adjust. So we're looking here back in 2001 and 2007 and 2001. So in 2001, which is, let's just say for easy math, 25 years ago, there was a 50 basis point made right after the dot-com bubble. So we had a little bit of a push up in the market, around 6%. But a year later after that cut, look what happened. It went down 12.4. The next year went down 30%. The next year after that, 3 years later, 13.7. Then it went down 4.8%. And then 5 years later, it turned positive to 2.3. But does that make up for the previous 4 years? I haven't added all of this up, but you get my point. Well over 10%. And these are nominal numbers. These numbers do not include inflation. So even though you might see a nominal increase 5 years later at 2.3%, when you factor in inflation, you're still behind the 8 ball. I move up to 2007. Remember, I just said about 2 minutes ago, ironically, September 18th, 2007 is when the Fed did a 50 basis cut. Just like September 18th of 2024, ironically, they did 50 basis points. So 2007, 17 years later to the date, we have the same basis cut of 50 points. What happened? You had a little bit of a bump of 4.7%, but a year later, so we would be looking at what, roughly around September or October of 2025, this went down almost 19%. This went down 26%. This went down 20.7%. Then it went positive in year 4 at 12.8. So even at that point in time, if you take into consideration all of these numbers here and factor in mild inflation, when I say mild inflation, historically speaking, inflation averages around 3.4 to 3.8%, depending upon what metrics you look at. That goes back since 1960, I believe, if I'm not mistaken. So if you factor in mild inflation, you're still light years away from getting your money back if you're in the stock market and was listening to, once again, your financial planner or that person who comes in representing your 457 plan with $20 shoes on, telling you you can't time the market. Once again, I know you can't time the market, but you can get some indications that maybe you need to reallocate your resources to more safer investments so you can ride out the storm and then re-enter when it's a little bit sunny outside. But I think it would be prudent to say, hey, there's clouds in the air. I don't know exactly when it's going to rain, but I'm pretty sure it is. So instead of me trying to time exactly when it's going to rain, I'm just going to take shelter until it starts to sunlight, until we see sunlight again. So I hope you enjoyed that part of it. We're going to jump over here real quick because I'm getting a little long in the tooth. And we're going to talk about some stock stuff. And then that's going to do it for this show here. So let me pull this up 1 second. And give my mouse a moment to adjust. So those of you who followed me last Friday, last Saturday, my number one recommendation that I was following was Caterpillar. That stock symbol is CAT. I don't know why I can't talk. It's CAT, CAT. At the time, go back and look at the video. I said that I had several calls at $345 a share. I said at that point in time last week that I thought that Caterpillar could go up to 350. What you're seeing right now, I'm actually filming this at around 11 a.m. on Friday, so the market is still open. It's at $370. So it's $20 over where I thought it would be when I went into the trade at 345. Now, I forgot exactly where I got out at. I think I got made like 66% or something like that. So I don't know the exact amount, but great trade. For those of you who follow options or do swing trading, if you're still in this and you follow what I'm doing, which is not financial advice, you're making a ton of money. And if you took out an option and you didn't cash out, because I don't like to get greedy. So once I get my 50 to 60%, sometimes I just get out. But if you're still riding this, you probably are up 300 or 400% within 7 days. The other recommendation I made, and you can go back and look at this, was ExxonMobil Corporation, and that stock symbol is XOM. I entered it at I think it was at 112, and I said it could probably go to 114, 115. I think I got out at 114 at about 44% in less than 24 hours. And as you can see here in real time, it's already up 115. So as you can see here, I had my signals showing me that was buy. I was talking to you guys that I thought this was a double bottom and that it was going to be confirmation to start to go on its way up. So what am I doing for next week? I've already entered a trade. I haven't looked at it in the last couple of minutes. So let's see where it's at. It's IWM, which is the Russell 2000. And I have put in what's called a put option, which is predicting that I think the IWM, the Russell, is going to start to go down. At the time I placed that trade, I think it was close to $223.20 per share. It's down to $222.30. Once again, bottom right here, real time. So, and I'm in this trade for a couple of weeks. I'll probably close it out Monday or Tuesday. I haven't looked at the numbers right now, but I'm probably already up 5% on this trade. I haven't even been in the trade 15 minutes. What was my rationale for this pick? Let's take a look at it. Well, let's look at the top here. And those of you who have followed me know I say about here's a top, here's a top, here's a top. So what you're getting here, let me draw a line here. See that? That's resistance. It really can't go above 224. And the day before, it pretty much tried to go above it, but it settled a little bit before that. And now it seems like it's coming back down. So I think the Russell 2000 or the IWM can pull back a little bit. My put is for 220. So I think I've got a realistic shot at making 100% on this trade. But once again, if this trade's at like 221 or 220 and a little bit more than 220 on Monday, and I'm at a 40 to 60% profit, I'll probably just close it out and not be greedy, because this green line here, which is the 200-day moving average, is still swinging up, which means that's positive momentum. I do not recommend people trying to get in and get out of these type of trades using options unless you're well versed and understand the market very closely. Also, which was leading or helping me make that decision, is the RSI. And as you can see here, it's level. When the blue line goes underneath the red line, that means that the stock is getting ready to turn down. As you can see here, it looks like it's getting ready to turn down. So I'm jumping the gun a little bit, but I'm also looking at some historical data to say, look at this, going all the way back to May, this topping right here. See, once again, let's see if I can get this thing to do this. All right, hold up. Here we go. Perfect. That's not the, you see this line here that I can't draw straight? That's almost like a resistance level. It can't really go any higher than that. And that's what I was looking at when I made the decision to say, I think the IWM is pretty much topping out. It needs to take a breather. It needs to pull back just a little bit. It's not going to come all the way down here. I don't see that, but it just needs to come down maybe $1 or $1.50 for me to make 40 or 50% on my money. So I hope you've got some good information. Once again, look at that chart that I showed you about what happens to the stock market in subsequent years after there's a 50 basis point cut to start with. It doesn't happen that often. That's typically ominous. So once again, if you are contemplating retirement in the next 3 to 5 years, stay in the market at your own peril. This is going to do it for the Kevin Strong Show. Sorry for being a little bit longer than normal, but if you enjoyed this and got some good information or seen a different twist out of it, do me a great solid by hitting the like button, commenting, and share. And once again, for those who have followed me on Facebook, continue to watch me there because I will continue to monitor and post my results. And finally, last but not least, those who have been following me know that I was one of few people that 3 weeks to 30 days ago, before the Fed cut, I said that the Fed was going to cut by 50 basis points, where the norm was everybody was on the side of thinking it was going to be 25 basis points. So, hey, I'm just sharing this information with you to add real value, to let you know that I show my losses, I show my wins, and to bring real value to the program. So if you think it's worth sharing my videos and saying, hey, follow this guy, he's got a pretty good track record of knowing what's going on, I would appreciate it. Have a great weekend, ladies and gents, and I'll see you in the next one. Thank you for watching The Kevin Strong Show.